Derivatives by Ashley Mecum. What is a derivative? A derivative is a security with a price that is dependent upon or derived from one or more underlying assets. It is a contract between two or more parties that specify conditions, such as dates, resulting values, and definitions of the underlying assets, under which payments are to be made between the parties. The most common underlying assets include stocks, bonds, commodities, currencies, interest rates, and market indexes. Derivatives in use. Hedging. Hedgers are those who enter a derivative contract with the objective of converting risk. It is the practice of taking a position in one market to offset and balance against the risk adopted by a position in a contrary market or investment. Speculation. Speculators are those who enter a derivative contract to make a profit by assuming risk. It is the practice of engaging in risky financial transactions in an attempt to profit for short or medium-term fluctuations in the market value of a tradable good, such as a financial instrument, rather than attempting to profit from the underlying financial attributes, such as capital gains, interest, or dividends. Arbitrage. Arbitrageurs perform the function of making prices in different markets converge and be in tandem with each other. They are also focused on profit like speculators. Here you will see two charts regarding derivatives markets. One is financial exchanges and the other is over-the-counter. Financial exchanges, you see, will drop down to future exchanges and security exchanges. Future exchanges deal mostly with options and future contracts, where security exchanges deal mostly with shares, warrants, options, and secured structured products. Over-the-counter works with both commercial banks and investment banks and brokerage houses. Both of these branches work with forward rate agreements, caps, floors, collars, credit default swaps, etc. Over-the-counter derivatives constitute the greater proportion of derivatives in existence, and they are unregulated, whereas derivatives traded on exchanges are standardized. Over-the-counter derivatives generally have greater risk for the counterparty than do the standardized derivatives on the financial exchanges. Originally, derivatives were used to ensure balanced exchange rates for goods traded internationally. With differing values of different national currencies, international traders needed a system of accounting for these differences. Today, derivatives are based upon a wide variety of transactions and have many more uses. There are even derivatives based on weather data, such as the amount of rain or number of sunny days in a particular region. So it's not just finance that derivatives are used. Common forms of derivatives. Futures contracts. Futures contracts are one of the most common types of derivatives. A futures contract, or simply called futures, is an agreement between two parties for the sale of an asset at an agreed-upon price. One would generally use a futures contract to hedge against risk during a particular period of time. Forward contracts. Forward contracts are another important kind of derivative, similar to futures contracts. The key difference being that unlike futures, forward contracts, also called forwards, are not traded on exchange, but they are rather only traded over the counter. Swaps. Swaps are another common type of derivative. A swap is most often a contract between two parties agreeing to trade loan terms. One might use an interest rate swap in order to switch from a variable rate interest loan to a fixed interest rate loan, or vice versa. Options. Options are another common form of derivative. An option is similar to a futures contract in that it is an agreement between two parties granting one the opportunity to buy or sell a security from or to the other party at a predetermined future date. Yet the key difference between options and futures is that with an option, the buyer or seller is not obligated to make the transaction if he or she decides not to. Hence the name option. The exchange now itself is ultimately optional. Like with futures, options may be used to hedge the seller's stock against a price drop and to provide the buyer with an opportunity for financial gain through speculation. An option can be called either short or long, as well as a call or put. A credit derivative is yet another form of derivative. This type of derivative is a loan sold to a speculator at a discount to its true value. Though the original lender is selling the loan at a reduced price and will therefore see a lower return, in selling the loan, the lender will regain most of the capital from the loan and can then use that money to issue a new and ideally more profitable loan. If, for example, a lender issued a loan and subsequently had the opportunity to engage in another loan with more profitable terms, the lender might choose to sell the original loan to a speculator in order to finance the more profitable loan. In this way, credit derivatives exchange modest returns for lower risk and greater liquidity. Lastly, mortgage-backed securities is another common form of derivatives. It is a broad category of derivative, simply defined by the fact that the assets underlying the derivative are just mortgages. Limitations of derivatives. First off, generally speaking, the key to making a sound investment is to fully understand the risks associated with the derivative. These risks include the counterparty, underlying asset, price, and expiration. The use of a derivative only makes sense if the investor is fully aware of the risks and understands the impact of the investment within a portfolio strategy. A counterparty is another party that participates in a financial transaction, and every transaction must have a counterparty in order for the transaction to go through. More specifically, every buyer of an asset must be paired with a seller who is willing to sell, and vice versa. All trades require some sort of counterparty. So, for example, looking at our options contracts, the counterparty for that would be an option contract buyer, and the counterparty to the buyer would be an option writer. The underlying asset is the financial instrument, such as stock, futures, a commodity, a currency, or an index, on which the derivative's price is based. This leads us to talk about price. When we talk about price, we think mostly the strike price. The strike price is the price at which a derivative can be exercised, and refers to the price of the derivative's underlying asset. In a call option, the strike price is the price at which the option holder can purchase the underlying security. For a put option, the strike price is the price at which the option holder can sell the underlying security. Lastly, an expiration date in derivatives is the last day an options or futures contract is valid. When investors buy options, the contracts give them the right, but not the obligation, to buy or sell the assets at a predetermined price within a given time period, which is on or before the expiration date. If an investor chooses not to exercise that right, the option expires and becomes worthless, and the investor loses the money paid to buy it. That is all I have for today regarding derivatives. Thank you for listening, and please note all my information was sourced from Investopedia.com.